If I told you that price goes up when there are more buyers than sellers, I'd be lying to you. In modern markets, that sentence is completely wrong, and believing it is exactly how smart money unloads their bags on retail. Here's the problem. On any exchange, for every trade, there is one buyer and one seller. The quantity bought equals the quantity sold. Always. So there cannot literally be more buyers than sellers in executed trades. What actually changes is who is more aggressive and who hits the other side's orders. Today, I'm going to show you how price really moves using supply, demand, order books, and wick-off logic in a way you'll never unsee again. By the end, you won't look at a chart as random candles anymore. You'll see a war between aggressive and passive money. Welcome to Trader's Bible, the quiet room for market mastery. Let's get into it. Let's fix the biggest misconception first. People say price went up today because there were more buyers than sellers. Sounds logical, right? You open your trading app, you see a big green candle, volume is spiking, and your brain immediately goes, lots of buyers showed up. But here's the problem with that logic. For every single share, contract, or coin that gets bought, someone on the other side has to sell it. If you buy 100 shares of a stock, someone else sold you exactly 100 shares. The math is perfect. 1 to 1. Always. There is no magical universe where 60 buyers show up and only 40 sellers appear. That's not how exchanges work. Every executed trade is a perfect match. So if the quantity bought always equals the quantity sold, how can there possibly be more buyers than sellers? The answer is simple. There can't be. What actually changes is not the number of people on each side. What changes is who is more desperate, who is more aggressive, and who is willing to accept a worse price right now to get filled immediately. Think about it like this. Imagine you're at an auction for a rare collectible. There are 50 people in the room. 10 people want to buy it, and 10 people are willing to sell similar items. Now, if all 10 buyers are patient and say, I'll only pay $100, and all 10 sellers are also patient and say, I'll only accept $150, nothing happens. No trade. Price doesn't move. But the moment one buyer says, forget it, I need this now, I'll pay $150, boom, trade happens. Price just moved up. Not because there were more buyers in the room, but because one buyer got aggressive. That's the entire mechanism of price movement. Aggression versus patience. Market orders versus limit orders. And this is exactly how smart money traps retail traders. They know retail looks at a green candle and thinks, everyone is buying, I should buy too. So smart money sits there with massive limit sell orders just above the current price, waiting for retail to hit those orders with market buys. Retail thinks they're chasing momentum. Smart money knows they're providing exit liquidity. You're not buying because there are more buyers. You're buying from someone who has been waiting for you to show up. So instead of asking, are there more buyers or sellers, start asking, who is more aggressive right now? If you see price climbing steadily, it's not because buyers outnumber sellers. It's because buyers are hitting market orders and sellers are getting consumed. And the moment that aggression stops, the moment buyers become patient again, price stops moving. Even if there are still plenty of people who want to buy, they're just not willing to pay up anymore. That distinction is everything. Now let's go deeper. If aggression is what moves price, where does that aggression actually hit? It hits the order book. And this is where most traders go completely blind. They stare at candlestick charts all day, watching red and green bars, and they have no idea what's actually happening underneath. The order book is the battlefield. It's where real supply and demand live. Not on your chart. On your chart, you're just seeing the scoreboard. The game is being played in the order book, and if you don't understand it, you're trading with a blindfold on. There are two types of orders that matter. First, limit orders. These are the patient ones. I want to buy at $50 or better. I want to sell at $52 or better. These orders don't move price. They just sit there, waiting. They build the structure of the order book. On the buy side, these are called bids. On the sell side, these are called asks or offers. When you look at an order book, you see a ladder. Maybe there are 500 shares waiting to be bought at $50, another 300 at $49.99, another 200 at $49.98. That's the demand side. Then on the sell side, maybe 400 shares are waiting at $51, 600 at $51.01, and so on. That's the supply side. These limit orders are the real supply and demand in the market. They're the fortress. They're the walls. And they don't move until someone attacks them. That's where the second type of order comes in. Market orders. These are the impatient ones. Fill me now. I don't care about the price. Just get me in. When you click market buy, your order doesn't sit and wait. It immediately crosses the spread, hits the lowest available sell limit order, and consumes it. If you're buying 100 shares, and there are only 50 shares waiting at $51, Your order eats those 50, then moves up and eats the next 50 at $51.01. Price just ticked up. Not because more buyers showed up, but because you, the aggressive buyer, consumed the available supply at $51 and forced the next trade to happen at a higher price. That's it. That's the entire mechanism. Market orders move price by consuming limit orders. And in Wyckoff's language, limit orders are where supply and demand live. Price movement is just market orders hitting that supply and demand and pushing through it. So when you see price moving up, what's really happening is market buy orders are lifting the offers. They're hitting and consuming the sell limit orders at the ask. If buyers keep attacking, they eat through all the sellers at that level, and the next available sellers are higher. Price ticks up again. And here's where it gets even more interesting. If you have short sellers with stop losses just above a certain level, when price tags those stop losses turn into market buy orders too. Now you have real buying on top of forced buying. That's how you get short squeezes. It's not a flood of new bullish buyers. It's trapped shorts getting squeezed out, and their forced buying pushes price even higher, which triggers more stops, which creates more forced buying. It's a cascade. The same thing happens in reverse. Price moves down when market sell orders hit and consume the buy limit orders at the bid. Once those bids are gone, the next buyers are sitting lower, so price drops. And if long traders have stop losses below a level, when price hits those stops, they turn into market sells. That creates liquidation cascades. Price falls, stops get hit, more selling, more stops, more selling. It's a feedback loop, so the summary is simple. Market buys lifting the offers equals up moves. Market sells hitting the bids equals down moves. Not more buyers than sellers. Just more aggressive buyers versus more aggressive sellers. And if you understand this, you can start to see why some moves are sustainable and others are traps. Because here's the thing. Price doesn't only move because one side is strong. Sometimes it moves violently because the other side just disappears. Imagine you walk into a supermarket. Today water is $1 a bottle, plenty of supply on the shelves. Tomorrow most of the suppliers vanish, and the shelves are almost empty. You don't need a huge rush of buyers for the price to go up. Just a few people walking in and trying to buy water is enough, because there's barely any supply left. The price can spike to $5, $10, whatever, just because there's nothing stopping it. Markets work exactly the same way. If sellers pull their limit sell orders, the ask side of the order book becomes thin. Maybe there were 1,000 shares for sale at $52, but suddenly 800 of those orders get canceled. Now there are only 200 shares. A small market buy order that would have barely moved price before can now blast right through those 200 shares and hit the next level at $53. Price just jumped a full dollar, not because of massive buying pressure, but because the supply disappeared. This is called a liquidity gap. And it's one of the most important concepts in modern trading. If buyers pull their bids, the bid side becomes thin. Modest selling can cause huge drops, not because everyone is panicking, but because there's no one on the other side to catch the fall. Price just drops through air until it finds the next layer of real buying interest. Wyckoff would call this no supply or no demand conditions, and it's crucial for understanding where trends can extend or where reversals can happen. If you see price breaking out, and you notice the order book is thin above, that breakout has room to run. There's no supply to stop it, but if you see a breakout and the order book is stacked, with massive sell orders just above, that breakout is probably going to fail. The supply is there, waiting. Retail just can't see it because they're only looking at the chart. They see the green candle and think momentum. Smart money sees the order book and thinks exit liquidity. This is also why you see those insane wicks on charts. Price spikes up or down for a split second, then snaps right back. That's a liquidity gap getting filled. Someone hit a market order in a thin book, price spiked, and then immediately got absorbed by the next layer of real orders. If you don't understand order flow, you look at that wick and think it's random noise. If you do understand it, you see exactly what happened. Someone got hunted, stops got triggered, liquidity got pulled, and the smart money was sitting there, waiting to absorb it all. Now let's bring in Wyckoff's secret weapon. The relationship between volume and price. This is where most traders completely miss the signal. They see high volume and think, strong move. But volume alone tells you nothing. You have to compare it to the result. Think of it like this. Volume equals effort. Price movement equals result. It's like watching someone try to move a boulder. If they're pushing with all their strength and the boulder moves 10 feet, that's a strong result for the effort. But if they're pushing with all their strength and the boulder only moves an inch, something is wrong. Either the boulder is too heavy or someone else is pushing back from the other side. Markets work the same way. High volume with a small price movement means huge effort, but tiny result. One side is attacking hard, but the other side is absorbing everything. Example. You see a massive green candle at a resistance level. Volume is through the roof. Everyone thinks breakout. But then the candle closes near its low, and price doesn't follow through. What just happened? Buyers attacked with huge volume, but sellers were sitting there, absorbing every single buy. That's hidden supply. That's distribution. The smart money is unloading, and retail is buying it all up, thinking they're catching a breakout. Wick-off traders see that high volume, small result pattern and immediately know absorption is happening. Someone strong is on the other side. This move is going to fail. High volume with a large price movement means huge effort and huge result. The dominant side is winning. Either it's a powerful breakout, where there's no supply to stop it, or it's a climax, where one side is exhausting itself at the end of a move. Context matters. If you see this pattern after a long uptrend, it's probably a buying climax. Everyone is piling in at the top, and smart money is selling everything to them. If you see it at the start of a new trend after a base, it's probably a legitimate breakout. The key is asking, is this the beginning of the move, or the end? Low volume, with a big price move, means small effort, big result. This is your liquidity gap in action. The other side has vanished. There's no one to stop the move, so price just flies. This can be a sign of trend continuation if it's happening in the direction of the established trend. It can also be a manipulated move in a thin market, designed to trigger stops and trap traders. You see this all the time in crypto and futures overnight. Price spikes 5% on tiny volume, smashes through stops, then reverses immediately. If you're not watching the order book in volume context, you think it's a real move. If you are watching, you see it for what it is, a liquidity grab. So every single candle, every single bar, you should be asking, given this effort in volume, is the result in price strong, weak, or suspicious? That's how wick-off traders read the battle. They're not predicting. They're observing. They're seeing who is winning, who is absorbing, and who is about to get trapped. And once you start doing this, you'll never look at a chart the same way again. Because all of this, the limit orders, the market orders, the liquidity gaps, the volume analysis, it all fits into Wyckoff's bigger framework. The four-phase cycle that every market moves through, over and over again. And if you don't know where you are in this cycle, you're probably providing exit liquidity to the people who do. Let me show you what I mean. Once you start reading effort versus result, you'll notice something strange. The patterns repeat. Markets don't just bounce around randomly. They move through the same cycle over and over again. And the professionals know exactly where they are in that cycle. Phase 1 is accumulation. This is where smart money is quietly buying from weak hands in a range. Price is going nowhere. It chops around. Retail traders get bored and leave. Nothing's happening here. But if you know what to look for, everything is happening. You see big volume on down moves, but price doesn't make new lows. That's the signal. Buyers are absorbing supply. Every time price drops, someone is there catching it. Weak hands are selling out of fear or frustration. Strong hands are accumulating their position. The order book might show aggressive selling, market sell orders hitting the bids, but the bids keep regenerating. New buy limit orders keep appearing. That's absorption. That's smart money building a position without moving price, because if price ran up too early, they wouldn't get filled at their target levels. Look at any major bottom in any market. Before the markup phase begins, there's always a period where price just grinds sideways or makes lower lows on declining momentum. Volume spikes happen, but price doesn't collapse. It holds. Retail sees this and thinks, weak bounce, going lower. Wick-off traders see this and think, supply is being absorbed, accumulation is happening. The key tell is effort versus result. Huge selling effort, tiny downside result. That means someone is buying everything being sold. And once that supply is exhausted, once the weak hands have sold everything they're going to sell, the next phase begins. Phase 2 is markup. Demand dominates. This is the phase where price actually trends. And it's the phase most retail traders are trying to catch, but by the time they recognize it, it's often halfway over or nearly done. During markup, you'll notice pullbacks are shallow. The market doesn't give you a big discount to get back in. Down bars happen on lower volume. That's a sign of strength. When price pulls back and nobody is aggressively selling, it means the sellers are exhausted. There's no supply. And when breakouts happen, they actually follow through. You don't see those fake breakouts that immediately reverse. The breakouts are real because the order book is thin above, smart money already accumulated. There's no supply to stop the move. Retail is either sitting on the sidelines waiting for a better entry, or they're shorting because it's overbought. Either way, they're not in the trend, and the trend just keeps going. This is where the effort versus result framework becomes critical. If you see low volume on pullbacks and high volume on rallies, that's healthy markup. Buyers are in control. But if you start seeing high volume on rallies with small results, be careful. That's a warning sign. That's supply starting to show up. Smart money might be starting to distribute. And that takes us to phase 3. Phase 3 is distribution. This is where smart money is selling to the public near the top. And it looks exactly like accumulation, except in reverse, and at a higher price. Price enters a range again. It chops around. But now retail is excited. We're consolidating before the next leg up. They see every dip as a buying opportunity. They see the range as a bullish flag. But what's really happening is the opposite. Every time price rallies, smart money is there with limit sell orders, unloading their position. You'll see strong up bars on big volume, but then no follow-through. Price rallies hard, volume spikes, everyone thinks breakout, and then price just dies. It closes weak. It reverses the next day. That's supply overcoming demand. That's distribution. The effort is there, the volume is there, but the result is weak. Buyers are attacking, but sellers are absorbing everything and more. The key difference between distribution and accumulation is what happens after the high volume moves. In accumulation, high volume down moves hold and don't make new lows. In distribution, high volume up moves fail and don't make new highs. If you see price rallying on huge volume but consistently failing at the same resistance level, that's not a breakout waiting to happen. That's a ceiling. That's smart money selling. And once they've distributed their entire position, once there are no more buyers left to sell to, the final phase begins. Phase 4 is markdown. Supply dominates. This is the downtrend. And just like markup, it's the phase retail traders are always trying to catch, but they keep buying the dips instead. During markdown, rallies are weak. Up bars have low volume. When price bounces, nobody is aggressively buying. It's just short covering or dead cat bounces. And then price falls again, often on increasing volume. The sell stops get triggered, liquidation cascades happen, and the cycle feeds on itself. Retail keeps saying, it's oversold, it has to bounce. But oversold can stay oversold for a long time when there's no demand. The order book shows thin bids. Every rally gets sold. And smart money isn't catching the falling knife. They're waiting. They're watching. And when price finally reaches a level where value is extreme, where fear is at a peak, where weak hands are capitulating, that's when accumulation starts again. The cycle resets. Here's what most traders get wrong. They think they can identify these phases in real time with perfect accuracy. They can't. Nobody can. But that's not the point. Your job as a trader is not to predict the future perfectly. Your job is to read the probabilities. To ask yourself, am I seeing absorption or distribution? Are down moves being caught or are up moves being sold? Is the market rewarding aggressive buyers or aggressive sellers? Is the order book thick or thin in the direction of the move? All of these micro-observations, the limit orders, the market orders, the volume, the price result, they give you clues about where you are in the cycle. And once you have a hypothesis about the phase, you can align your strategy. If you think you're in accumulation, you're patient. You're looking for long setups. You're not shorting just because price looks weak. If you think you're in markup, you're riding the trend. You're not trying to pick tops. You're letting runners run. If you think you're in distribution, you're cautious. You're taking profits. You're tightening stops. You're not adding to positions just because price hit a new high. And if you think you're in markdown, you're defensive. You're waiting. You're not catching knives. You're letting the phase play out. The biggest mistake retail makes is trading every phase the same way. They try to buy breakouts in distribution. They try to short rallies in markup. They try to hold through markdown because it's a long-term investment, and they wonder why they keep losing. It's because they don't know where they are in the cycle. They're trading blind. They're providing exit liquidity to the professionals who do know. Smart money accumulates when retail is fearful. They mark up when retail is skeptical. They distribute when retail is greedy. And they mark down when retail is still hoping for a recovery. It's the same playbook, over and over again. And if you can learn to read it, you stop being the exit liquidity and start being the one positioning ahead of the move. So the next time you open a chart, don't just ask, is this going up or down? Ask, where are we in the cycle? Look for the absorption patterns. Look for the effort versus result mismatches. Look at the order book. Look at the volume. Look at how price responds to aggression. Are stops being hunted? Is supply being absorbed? Is demand showing up on dips, or is it vanishing? These questions will tell you more than any indicator ever will. Let's bring this full circle. You came into this video thinking price moves because there are more buyers than sellers. Now you know that's not how it works. Every trade has exactly one buyer and one seller. What actually moves price is aggression. Who is hitting the other side's orders with market orders? Who is consuming the limit orders sitting in the order book? And who is waiting on the other side, absorbing everything? You learned that real supply and demand don't live on your chart. They live in the order book as limit orders. Price movement is just the scoreboard. The game is being fought where patient orders meet impatient ones. You learned that violent moves aren't always about strength or weakness. Sometimes they happen because one side simply vanished. Liquidity gaps. No supply. No demand. And if you're not watching the order book, you'll think it's a real breakout, when it's actually just air. You learned that volume without context is noise. But volume compared to the price result tells you everything. High effort, small result. Absorption. Someone strong is on the other side. High effort, big result. Dominance or climax. Low effort, big result. Liquidity gap. The other side disappeared. And you learned that all of this fits into a predictable cycle. Accumulation, markup, distribution, markdown. The professionals know where they are. And now, so do you. The shift here isn't about learning a new indicator or a secret pattern. It's about changing how you see the market entirely. Stop looking at candles and start seeing the war. Stop chasing green and start reading aggression. Stop thinking in more buyers and sellers and start thinking in order flow. Because once you see it this way, you can't unsee it. And that's when you stop being exit liquidity and start positioning like the smart money. Thanks for watching Trader's Bible. If this changed how you see price, you know what to do.